Okay, so I just want to continue where we were just before. We'll go over an example now. Suppose that we have n variables follow a stochastic process. Okay, so then our formula would look something like, we'll have an index now. Theta I n t plus s I c I. Okay, so then we can use Ito's lemma to show this. Show that a derivative that derives its value from all of these thetas would have this process. Okay, so this ends up being the expected value of this investment, the expected return, not necessarily R, of that investment. Those would collapse into the same one because it's all for one investment. But this would be individual, this would be all the different sigmas and all the different Wiener processes multiplied together. We'd add them up. Okay. Then, so that's where sigma is the expected return of the security, and this component is, yeah, like we said, so yeah, this is the expected return of the investment, and then this is the volatilities, the individual volatilities times the individual Wiener processes. And then we can say mu minus R is therefore equal to the lambda I sigma I, the formula we had last time we talked. So these two multiplied together would end up equaling this. So this is how much we want above the interest rate would be equal to all the lambda i's times the sigma i's. So if the lambda i's, like we had the example last class, if these were all zeros, then mu would equal R. The expected return would be the same as the interest rate. So an example of this would be, suppose we have a stock that depends on three things. Let's say it depends on the price of oil, it depends on the price of gold, and let's say it also depends on a stock index. So a stock index like the Dow Jones Industrial Average. So you tell me the price of oil, gold, and stock, as that's changing, I can calculate how much the stock is going to change. Suppose you concluded that a stock moves with these three things. So now we're kind of getting away from the idea of, you know, it's a stock and the derivative is, let's say, a call option or a put option on the stock. Now, all of a sudden, the stock is moving with changes in these three. Okay, and suppose that the market price of risk for each of these, I'm going to draw this like a chart. The market price of risk for each of these is lambda for this one, let's see, lambda oil equals 0.2, lambda gold equals negative 0.1. Like we said last time, we could have a negative number for the lambda. And then the lambda for the stock index equals 0.4. And then let's say the sigmas for each of these. Let's say this. The sigma for oil is 0.05. Sigma for gold is 0.1, and the sigma for the stock index is 0.15. Okay, suppose we wanted to know what is the expected return over R. How much over R is this investor expecting to get? So that would end up being this investor's mu minus R. What is their mu minus R equal? And we said before, the mu minus R is 0 to n of the market price of risk of each investment times the sigma of each investment, which equals 0.2 times 0.05 plus negative 0.1 times 1 plus 0.4 times 0.15. And this all equals 0.06. So this investor is looking to get 6% more than the interest rate, on average. So when the numbers work out that we could get 6% more than the interest rate, that's when people start investing in this investment. So if the numbers worked out that this was like 0.5, then you might start seeing people sell this investment. If it gets to 0.7, then a lot more people dive in. But the market for this particular investment, people are seeking 6% more than the interest rate. And that will then tell you where the market's going to meet. And that's where the price of this stock will end up being. So we were talking about risk neutral prices in the past, like a stock we used to say like people will figure out what the price of the stock is going to be a year from today and then subtract interest, and that's what they would pay today for it. Now it turns out if this stock happens to be, we're now treating this stock as a derivative. We're treating it as something that derives its value from these three other things, these three other values. And then from those values we can figure out each of these individual values have their own market price of risk, and from that we can figure out what the investors are trying to get on top of the interest rate, and then from that we can figure out what the stock price should be today. Okay. So now, back to another topic we've hit in the past, is martingales. Okay, so remember what a martingale was? Like loosely defined what a martingale was? All right, well, we'll say this. It's a stochastic process with zero drift. So another way we could look at that is we could say that if at any point in time we looked at its value and we asked ourselves at some point in the future what would we expect its value to be, it would be the most recently observed value we've seen. It's not expected to go up or down in value. So we could say the derivative, the rate of change of a martingale would be equal to, it would end up being mu, well the mu would end up being 0. It would end up being mu t plus sigma dz, but considering the fact that this is 0, this then equals sigma dz. So really all it is a martingale is any process that is, just a Wiener process, maybe even times a factor. But it doesn't drift up or down, but it can move around. Okay, and then we also say that it has the expected value. The expected value of the process at time t is equal to the expected value when it originally started, at time 0. Okay. So now, suppose that F and G are prices of securities suppose F and G are prices of securities dependent on a single source of uncertainty. Okay, so these are two, you could think of them now as F and G are two derivatives. They're deriving their value from some other, say, Wiener process. Okay, then we'll define what's this letter again? I gotta learn all the Greek letters. Phi? Okay. So we'll define phi as F divided by G. So phi is a price that is, it's the relative value of F to G. So let me just throw in an example.
Phi means that it's normally distributed. Is that what?
No, this is a different phi. Yeah, so when we talk about, normal variables, sometimes you'll see like an n, 0, 1, that means a normally distributed variable with a mean of 0 and a standard deviation of 1. And other math books will do this. It's usually capital phi. They'll usually say that, right? And that's what you're thinking of. It's the same letter, but it's just being used for a different thing here. Okay. So let me throw in an example. It's suppose we have F equals IBM stock, which is currently selling for $100 a share, and G is Microsoft, which is currently selling for $50 a share. If we define phi to be IBM divided by Microsoft, then we would get 100 over 50 equals 2. So what phi ends up being is a relationship of one divided by the other. So phi is really a ratio of one thing to another. Okay. So yeah, this could be thought of as measuring the price of F in units of G rather than in units of dollars. So like IBM is 2 Microsofts. Instead of being, you could think of IBM as being worth $100. Microsoft is, I'm sorry, IBM is worth $100, Microsoft is worth $50. And you could also think of it in terms of phi. IBM is worth 2 Microsofts. Okay. Okay, and then the thing we're using as the denominator is sometimes referred to E is referred to the numeraire. And if you type that into Microsoft, it treats it as a misspelled word. It's not in Microsoft's Word. You know how in Microsoft Word, if you type in words and you spell them wrong?
Right.
It looks it up in their dictionary. So apparently it doesn't know about this word. It keeps typing it in wrong, and I keep checking if I misspelled it, and I didn't. So, okay. Okay, so now, let's see, the equivalent Martingale measure result shows that for a choice of some lambda. So that's our market, this we'll call our market price of risk. For some choice of lambda, this will end up being, this will be a martingale. And it turns out that if we choose lambda to equal the volatility of G, for that particular lambda, the ratio of the one stock over the other is expected to stay the same. So that's what the Martingale, the equivalent Martingale measure result shows. So, and that would be, so this would, for this choice, if we, I should have said choose this one, because we can choose any one, but if we chose this one, we would then get, for choice, lambda equals sigma g, all all sigmas for any f, f divided by g, f divided by g, are Martingale. Okay, so let me go over, so we'd have df, now this is any derivative would be r plus lambda sigma. This is just another way we had of writing mu minus r minus lambda sigma f of dt plus sigma f dz. So that's the formula for this derivative, and we replaced this is new for what used to be mu minus r. Okay? And df equals r plus sigma g sigma f times f dt plus sigma f dz. And this should be sigma f. Okay, then d of g equals r plus sigma squared g. So all we're doing here, we're using sigma g in both cases, and this would be sigma g times sigma g for this formula. And everything else seems okay. Then by Ito's lemma, Ito's lemma would show this. Okay. And then combining these two lines, we would end up with that can be used to determine the process for f divided by g. If we wanted to come up with a derivative that tracks f divided by g, use Ito's also to get the rate of change of f divided by g equals sigma f minus sigma g times f divided by g dz. Okay, so it's basically what we did was, this is like a night of formulas, really. But basically what we did was we defined a variable, f divided by g, and then we wanted to use Ito's process, and using the formula for the f, which is really combined with g, and the formula for g, which is just made up of g sigma and r. Combining these two formulas to then use Ito's lemma to come up with a process for f divided by g. So if we had a variable f divided by g and just let it run, this is what it would turn out to be. And this component here is the volatility. It's one volatility minus the other volatility. This could come out to be 0, or it could come out to be something. And volatilities can come out negative. Would that throw you off at the volatility? Because we end up really using the absolute value anyway. Does it not make mathematical sense that the volatility could be a negative? Because in this case, if one is, like the example we had before, this could be IBM and this could be Microsoft, and they're both going to have two different volatilities, there's no guarantee that the second one is less than the first one. So the door is now open for volatilities to be negative. But we're taking that volatility and multiplying it by a Wiener process, and a Wiener process is average is 0, it could be positive, it could be negative, and then we're just multiplying that by a number. If that number happened to be negative, it would be just reversing the sign of the Wiener process, which is still another Wiener process.
Isn't that like mean reversion or something
Yeah.
like that?
So it's not throwing us off that this could come out negative. But the interesting thing, the interesting result here is there's no drift. Right there.
Because of the possibility of a negative volatility, right? Isn't that a part?
No, I'm just saying this equation, Ito's lemma would produce this equation for the process of f divided by g. So let's say for it's like this gets you start to lose some of the intuition with these if you don't stick to a concrete example. But let's say, for example, f was IBM stock and g was Microsoft stock. If we wanted to come up, so if IBM is selling for 100 and Microsoft is selling for 50, it currently equals 2. If we let that IBM divided by Microsoft run as a process, this would be this would describe that process. So if this equation had some drift to it, if there was a term in here that said like something blah 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 times time, as time goes on it goes either up or down, then we'd say, okay, it is expected that the ratio of IBM to Microsoft is expected to drift upward. IBM is expected to beat out Microsoft, or Microsoft is expected to beat out IBM over time, then it would start drifting downward. But what we're saying here is that there's no drift
Term.
to that. Yeah, there's no drift term to this ratio. But that is under the assumption that we used the we had to use the lambda equaling the volatility of the denominator, the numeraire term. With that lambda, this ends up being the equation. and therefore has no drift, then therefore it's a martingale. So it could turn out, let's say for example, IBM is a much more volatile stock. Investors might want to have a better expected return than Microsoft. And therefore, you would expect the ratio, this ends up being the ratio, you would expect the ratio to drift upward. But using the lambda equal to the, setting lambda equal to the volatility of the numeraire, then it is expected that this ratio would stay the same. And therefore it'd be a martingale. Now suppose, like for example, suppose we decided we wanted to use, so we can actually now use anything as the numeraire, as the denominator to set up this ratio. Suppose we decided to use, as an example, money market as the numeraire. Okay, so the money market grows, now the money market in this example, sigma is what? Well, mu is what? The drift rate is R, right? Money market is you're putting the money in the bank and collecting interest. So the drift rate is R, and sigma is what? How volatile is the money market? There's no volatility, the money market, right? Okay, so for the money market, we're using the money market as the numeraire. So the rate of change is equal to R times G dt. There is no sigma term. Okay, so this is like saying F divided by G, where F can be anything, is a martingale in a world where the market price of risk is 0. Which we've been calling all along the, right? Does that make sense? To the mindset of a person who wants to invest with a market price of risk of 0, they're looking for a return equal to the interest rate. They're not looking for more than that. They're just looking for the return of an interest rate. They want the same return as putting money in the money market for their investments. So, to that mindset, if they then go out and start investing in something called F, any security F, if their mindset, they're using the money market as their numeraire, then the value of a security, F, the value of a security at time 0 would be the value of the G security times the expected value, and we'll put a little symbol over here that says the F at time T and the G. Okay, so putting an investment, this would be putting money in the money market, right? So let's say you put $1 in today and it grows at, let's say the interest rate is 5%. You're putting $1 in today, and then you're saying the expected value of your other investment divided by how the money market would do. This expectation times this initial investment should equal what your initial investment of the other security should be. So it's basically saying that the ratio of your investment, trying to put this into English, the ratio of your investment, let's say a person who has a risk-neutral mindset wanted to buy stock. So they know they can make 5% if they put their money in the bank, or they could buy the stock. What will drive the price if their mindset is they want to be in a risk-neutral world? Their expectation for the stock should be that the stock will gain, the expected gain would be 5% too. That's at the point where they would be motivated to invest in that. If the expected gain was 5% or more, they would invest in the stock, and if it was 5% or less, they would choose not to. Does that make sense, or is that the way it was coming up in your other class? So it's basically, it's kind of a mindset. The reason did the expected values have symbols on them, like little Q's here or hats on top of them? Because what's happening here is this is an expectation with a certain mindset. If you're saying, I want, my expected return is, in this case, my expected return is the interest rate. That's what I would like. So when I go out investing, I want to make sure, my mindset is I want to get an expected return of R. So what would motivate me, so this G, we said we decided to let the money market be the numeraire. So G is if we put our money in the money market. So if we multiply that times the expected value of this ratio, we should get this. So if the expected value of this ratio ends up being a Martingale, then that means the expected return on this investment is the same as R.
What would the little Q be? I mean, I think if there was a little Q there.
A little Q here?
Yeah.
Yeah, so it's there's always some symbol that ends up meaning it's the expected value under what they call under that probability measure. But what that basically means, it's kind of like our mindset. What we're looking to make as a profit, if that is our goal, then what we would expect this ratio to be if our goal was to hit a certain profit. So, yeah, I think our book uses a little hat, but other books would have a Q or some kind of symbol. So we're saying we're looking for, and with the mindset of getting this as our return, then with that mindset, what is the expected value of this ratio? And with that expected value, we should get the price of our security that we're considering buying, as opposed to investing in the money market. So it's really like the mindset is basically saying if we had a choice, like before, the example I had before where I had IBM and then the Numeraire was Microsoft. So we're kind of from the mindset of we could leave our money in Microsoft or we could go and move it to IBM. But we have a mindset of what we expect to get from Microsoft. And we're not going to move our money to IBM unless we can get the same expected result. So we're getting away from the mindset of using cash and the return on the bank, and comparing that to what we could do with our money. Like normally, the examples we've been doing pretty much up till now, we've always had the option to use cash to buy stock, and we would hope that the stock would do better than the cash. Now we're opening that door to saying, we'll only buy IBM if we could do better than staying with Microsoft. So now our benchmark doesn't have to be cash. Our benchmark can now be anything. But the thing that would make us shift from one to the other would be that we have a better expected value of the other. And the market should keep driving that mentality to the point where any two stocks divided by each other should remain a martingale. If they're not a martingale, then people should start shifting their money around so they all become martingales again. another example using a zero coupon bond as the numeraire. But again, if we just walk through that example, what we're then doing is we're looking at other investments, comparing that to putting our money in a zero coupon bond and seeing, is that better? So this is kind of a theoretical concept, and maybe we could, I won't give out a homework example like this, but I'll give out concrete examples with answers, so you get a sense for what these examples are, what this is getting at. But the overall idea is that,
How do you decide what can be F and G? I mean, we are saying they should have the same source of uncertainty, right? For example, when you take IBM and Microsoft, G as a Microsoft, how do we decide IBM will fit as F and G as a Microsoft?
well, no, yeah, so like I said, this is kind of a theoretical concept, but when you're deciding to use one as your numeraire, as kind of the denominator, it's kind of from the point of view of that's what your choice, you're comparing the new choice, the other choice, F, to staying with G. And if the expected value of, if the expected return of F ends up being better than G, you would want to sell G and buy more F with it.
But it could kind of be like the IBM stock, and the numeraire could be the IBM call option or something like that?
Yeah, well, actually, you could use anything as the numeraire, and that's what you're using to divide all your other possible investment choices by. And that ratio of the thing you're considering and the thing you're using as the numeraire, you could kind of think of it as you're considering selling the numeraire to buy the other one, the new choice. And you would only make that move if you expected this to do better than this. If you expected this ratio to be greater than 1, that would make you move over to that one. But the idea is that whichever numeraire you use, and we said earlier, if you happen to use lambda equals the, if you use lambda equals the volatility of the numeraire, this ratio should be 1. Therefore, the idea of moving from one to the other should not make anything better for you. So it's really like, our mindset before this was always taking cash and buying stock. Should we take our cash and buy stocks? Now it's like, should we take anything and use that to buy something else? So we don't have to, our mindset doesn't have to be cash versus buying stock. It's taking anything and using that as a basis to buy other things.